Good morning. This is Scott Amyx, and I'm joined by Victor Santos, CEO of Airfox. Welcome, Victor.
Hey, Scott. Thanks for having me.
All right. Now, you're originally from Brazil, and you came when you were much younger, I guess in elementary school age. Tell us a little bit about the inner workings of Brazil from an inside perspective. What are some of the social economic challenges, and why are you focusing on Brazil for your startup?
Yeah, I came to the U.S. Pretty early on and lived a typical immigrant story. Uh, my parents grew up as entrepreneurs, not because they wanted to, but out of necessity, both here in the U.S. and in Brazil. So I think that was instilled within me from a very early beginning. And one of the things that I very passionate about is financial inclusion. So when I was little, my parents always needing money to grow their business, and oftentimes were subjected to predatory rates for loans. I remember my mom, at 10 years old, taking my golden necklace from my soccer team to pawn it off to together with the family jewelry to try to get some money to save her travel agency business. So in Brazil, that's a real problem. It continues to be the problem. Top 5 banks control 90% of all the assets in the country. Compare that to 18%. So what we're providing is a more financial, inclusive way for people that are on the bottom of the pyramid to get online and have access to these financial services we take for granted. So it's a digital bank where users can simply sign up and have access to more affordable financial services.
Now, I believe you've also started a micro lending platform as well, right? And so again, I'm just trying to kind of tie it all together in terms of, especially for the underbanked in Brazil, what are their options or what are they have to resort to, and what's the danger of that?
Yeah, I mean, nearly half the population don't have bank accounts. So that's problem number one. And if you don't have bank accounts, the credit models are pretty archaic. So, if you're in an informal economy, you're never going to get a loan because the banks just don't have, if you're a subprime thin file customer, you just don't have enough data to give these users a loan. Or so you either get rejected, which is most of the cases, or they'll give you a loan, but it will be at a 400% APR. These are the choices that people are given. So what we do is we have a digital bank. So we give users a free mobile bank account as they start to use the app, and it's all through a mobile app. They can start paying their bills, sending money to friends. We also have a partnership with MasterCard, so they get a free prepaid MasterCard. And as they start using the app, we start to develop an underwriting system using alternative data and machine learning. So instead of relying on traditional factors like how much did I make the last 3 years, which are very archaic models, we use over 300 data points on the smartphone, from financial data to behavior data, in order to assess is this user reliable and can they pay it back, and and then give them a loan through this app, through our bank, to give them more access. So our cost of serving this user is a lot lower than the traditional banks.
Now, we're essentially talking about unsecured debt, right? It's in the form
Yes.
of personal loans or even credit card. Is that correct?
That's right. Yeah. Overdraft, personal loans, credit card.
Okay. So in that regard, prior to actually developing that underwriting data points to actually properly assign risk factors, what's kind of the initial starting block of what you actually lend or give them?
Yeah, we can't. That's why part of our beachhead is to give users a free bank account. So we need to be on their phones in order to measure, some of the same data points that Facebook or Google use to give you an ad. Essentially, use that for underwriting. So I'll give you an example, right? Like, it's the GPS location. Someone that moves a lot may not be someone that's reliable, right? Like, that's it's a very basic example. Or we have access to their carrier data in terms of, do they have the same SIM card for a long period of time, which means that, they've been paying their bills on time. These are more traditional signals that we can put into our model. The best signals we see is the financial signals within our app that are proprietary. So as they start to pay, they can't just sign up and get a loan. They have to start shifting some of their money with us, which is pretty easy because, today they have to stand in line if they're a cash-based customer to pay their bills. So having a simple app where you can just pay your bill with a click of a button makes it easier for them already. But then we start to see, did they pay their electricity bill on time? Did they, how long did it take for them to read the terms and services of the agreement? We see that fraudsters kind of like skip through it. So there's a lot of signals that we look at, and of course we're still learning. Thankfully, one of the big differences for us is that we have an investor and partner, which is the largest retailer in the country, that has about $1 billion loan portfolio. So we're starting with a pretty good set of data points and a pretty good set of customers that are pre-approved, that minimizes our risk a little bit.
In terms of the fact that you're monitoring various data points to get a kind of a vector of what their creditworthiness is, in that model, do you account for the fact that because they're underbanked or unbanked, and the fact that they don't have as many economic choices, that as their economic conditions improve, the underwriting factors also can improve? So in other words, it's much like credit card practices where you don't really know if they're going to truly be able to pay back unless you give them a little bit of line of credit, so to speak. How much of that is that in play, or are you guys, really looking at kind of current state versus potential?
That's a great point, Scott. That's exactly the model that we adhere to, is that we focus on smaller loans first. Almost like if I was an immigrant here and I had to build my credit, so you can get that prepaid credit card to build your credit. It's the same model. So our loans are very small, and that minimizes our risk, but also like allows us to know who's a good borrower or not. And then as that person starts to pay the smaller loan, now they can unlock larger loans. And then we're focused right now just purely on accessibility. We may not have yet the cheapest loans in the market, but we may be able to give someone who can't even get any access, that a loan. And eventually, as we build our data sets and these users that come back and for additional loans, ideally is that they will have a much better rate instead of a fixed rate, which is kind of the case today. Like even the pricing of these loans for traditional banks, they tend to be pretty straightforward, and there's no dynamic concept of like, okay, if I'm a good borrower, then I should probably get a better rate. It's like, okay, it's 5%, 7% a month, and that's pretty much how it is. So we're trying to build a more sophisticated system that, maybe you lost your job, you need an employment loan now, but now you start a new business. Now I need money to, grow my business. So we take, we almost look at a more idiosyncratic way how people are applying for these loans and what they're for.
Now, I know, again, I understand from your tie with Brazil, but why not also focus on domestic? So, these could be Latin Americans and others that are sending a lot of remittance, but also they themselves don't necessarily have any banking products. They're typically going to check cashing and paying with cash. Why not also serve them? Because ultimately the income generation in some cases is actually abroad and then sent to their domestic home country.
That's a great point. I think it's more a strategic decision for us. There are some challenges in the U.S. There is a market here, and especially within the immigrant community, the cost of operating a fintech is extremely high. So, for example, in the U.S., you need state-by-state license. So you can't just operate federally. In Brazil, it's different. If you have your payment institution, which is something that they created in the country to allow fintechs to compete with the bigger banks, it's similar to e-money license in Europe. You operate almost like a bank, but you're not really a bank. So that's not the case here in the U.S. You have to find a partner bank and custodian bank, and you have to have state-by-state licensing. So it's very cost prohibitive for us to come into the U.S. And I think there are other places that are already tackling this. So Square, for example, have Cash App, which they're starting to do remittance. They're starting to do debit card, and so I'm sure soon enough they'll be doing loans for consumers. I know they already have loans for small businesses. So I think the market here will is already on its way to getting, let's say, finding solutions for these problems. I think in Brazil, it's a little bit new.
Yeah, actually, that's a really reasonable point. Now, one of the things that I think some investors will ask is, how big is that TAM, right? So Brazil is one country, and then there's other countries within Latin and Central America that can also take advantage of this, as well as, African
Mm-hmm.
continent and Southeast Asia. So how large is really that addressable market? And do you generate enough volume and transaction to make this a viable, long-term, really cash flow rich type of a business?
Yeah, it's a good point. If you look at Brazil as a population, you have about 200 million people. So when you think about India, you have 1 billion people, but Brazilian currency is much stronger than the rupee or even the peso. So you could put Mexico's total, not from a people standpoint, but from a dollar standpoint, Mexico plus India, and you still don't have a bigger market, as big of a market as Brazil. So Brazil is smaller in terms of people, but it's very underserved, more so than India, because India has had the open banking, universal banking platform that they've launched with the government. Brazil is like 5 years behind. So that's an important point. The total TAM, I think Goldman Sachs report about Brazil just came out like about a year ago, estimated about I believe it was 75 billion in terms of TAM, and I believe that was reais. So divide that by 3-4. That's what we got for dollars. So it's a significant market, and that's revenue. That's not transaction volume. That's how much they estimate the new entrants will make and chip away from the banks. And like I said, when you look at the assets of the top 5 banks, Brazil has the most profitable banks in the world. So there is a way to make money. However, the challenge, to your point about how you make this a cash flow business and make it something sustainable, I think the challenge is there's not that much money in payments. However, payments is the entryway into making it a sustainable business. So we saw that with Square. Investors were very bearish with Square because it was very low margins. But over time, they were able to add adjacent services like software, like financial services, like loans for small businesses. And I think they've done a great job of that. And I think it's the same in Brazil. We're starting with the digital bank. People can pay their bills. They can get a free bank account with a prepaid card. Anyone can do that. Anyone, in the sense that anyone can just sign up, but the volume's high, margins are low. But as these people we build a data moat and as they start to use the app, we can now do loans, which are high margin businesses, insurance, fractional investing within the app, wealth management. So you start to go up the chain in terms of the services that you can offer, where you can start to make more money in these adjacent financial services that we launch. So I think that's at least our model, how we're thinking about it.
So can you share some quantitative metrics in terms of potential market share within Brazil, the kinds of volumes of transactions you're doing, the kinds of volumes of lending that you're doing? Because you do make a fair point. It really, the play is brand recognition in some ways. And once you have that captive audience, you can actually provide value-based strategy and holistic set of strategies. So the product extension becomes a lot easier once they trust and believe in that brand. So if you could kind of talk about that as well as a brand goodwill, that would be helpful.
Yeah, we're doing roughly, and it's doubled in one single month. About I think it's about 1 million in terms of a month of transaction volume, and I think we're growing to about 20 active users per day. And these are not accounts opened. That's a lot higher. That's in the few hundreds in terms of new accounts opened. And that's today, just to give you some sense, we're in about 10% of the stores of our partners. So one of the big strategies that we have is to have a digital app. Obviously, that's how users interact. That's how we have a lower cost to serve a user that's underbanked or unbanked. But our strategy is to have physical locations. This is the same idea in Africa with M-Pesa, where telcos had a branchless network of different retailers where people can put cash in, cash out, and get support for the app, and also as an acquisition channel. So this retailer was one of the largest retailers in the country, have about 1,000 stores, 20,000 sales people, massive foot traffic, 70 million of foot traffic a year. And we're now in 10% of their stores. By the end of Q1, we're going to be in all 1,000 stores. So that's going to drive a lot of volume for us. So today we're doing, like I said, about 25 per act per day, I believe, per store. I think that's roughly the numbers. The goal for next year is, be in the millions in terms of actives. Right now, I think we have total about a couple hundred thousand actives in terms of new accounts opened. So, it's still early, but I think we're kind of in that inflection point that starting to get really, we're increasing the saturation within these customers, and people are starting to become more aware of our brand. And partially that's to our retail partner, because they have a pretty strong brand in a physical location in terms of where people can go. Oftentimes, the neighborhoods these people live, there's no banks. It's like a grocery store. If you're in a low-income area, you go to the liquor store to buy your. In this case, there's banks are not open in the weekends in Brazil, are not for customers.
Okay, gotcha. Now, for the retail, would you actually need to have a physical investment into systems, or would you simply leverage the systems that these retail already have?
There's a little bit of integration up front, but there's very little cost to us, and that's the beauty of it. It's leveraging the retail's presence and having a piece of the store where it's almost like a bank, where the cashier that's already there, essentially doing their job. If someone goes in there and talks about banQi, they're trained. In Airfox, they're trained to know what to do, to say, okay, do you need to put money in? Let me tell you about this app. So all of the training and all of the operations is not done by us, but by the partner. And obviously there's a partnership there, so they make some money off that too. And then that's the goal, is to be more, have more permeability into their lives. So, you go to the store to buy something, it's like a pharmacy. That's another retail vertical we're looking at. Gas stations, like we want to be in these different retail locations, so there's more ways for them to engage with the app, but also deposit money in. The biggest challenge every digital wallet and every digital bank has is getting money in the app. It's a very difficult thing. It's a very, especially if you're paycheck to paycheck, so why would I put money in this app? So having a physical presence really helps with the user experience, but also to drive that trust for them to do that.
Yeah, it sounds like you guys have a unique set of challenges, but also the opportunity as well. My last question is a little bit of competition, but also potential acquisition. So what is the competitive landscape now, given the fact that it is very nascent, it is very early? And then secondly is you guys are really kind of early in terms of footprint. So I'm not sure if the traditional banks really perceive you as a threat yet. But if they do perceive you as a threat or think that you could be an extension to them, would that be a reasonable acquisition partner, or would you be looking to be independent or look for different partners such as telcos?
It's a good point. I think retailers, telcos, and banks are the ones get outside of, from an incumbent's perspective. Those are the ones that are getting into the digital bank space. It's a very heated space in Latin America right now. In Europe, I think the number one digital bank has I think over a few million customers. So it's the amount that they're valuing these customers are very high. So I don't know if that's sustainable over the long term. But in Brazil, a lot of the banks, what they're doing, the retailers, is that they're creating sub-brands. They're creating some sub-brand that's digital to try to appeal to that younger audience, the millennials. And today, the largest digital bank in the world is actually a Brazilian company called Nubank. So they're the second largest fintech in the world right now, and their focus is different than ours. We're not competing just yet because they're focused on the millennials, upperclassmen. So we call them like class A and B, and we're focused on the class C and D and E. So on the higher volume play for us. But of course, when they raise that much money, they have to go down eventually into the lower income. And I think at some point we'll probably clash. I still don't think we're necessarily fighting incumbents. I think it will converge at some point, and I'm sure there will be consolidation, and the banks will probably acquire one of these digital banks. But right now, I think I would say like Nubank is another fintech competitor. Neon is another one who just raised some money, and some of the retailers that kind of already serve the same population that our retail partner has are also underway to launch their digital banks. So I think that will probably at some point, they're a little bit behind, but at some point will come as a competitive force for us.
Sounds great. My last question is going to be, what was your greatest product or innovation failure that you can share, and the lessons learned from that?
Yeah. Wow, there's so many. Let me see. I think, a big thing about startups is that you have to be willing to fail and fail fast to learn. I don't think everyone has it perfectly. One of the biggest, I would say, challenges and failures was when we launched the credit product, the V1 of the credit product. We were in that mindset of, okay, move fast and break things. So we did get legal review, but it wasn't, we probably should have gotten a second opinion and probably should have moved a little bit slower, especially with credit. So we got a lot of fraud and a lot of things that we were doing in the beginning that weren't from a product standpoint, it was beautiful, but we weren't complying with the law at the time. So we had to stop, and that was kind of a waste because it was 6 months of us just building this product, and we had to start from scratch because we realized that there's a lot of things that we weren't complying. If we're going to be a serious business, so we needed to comply with that. So I think as an entrepreneur, it's always like you want to kind of move fast and you figure out regulation later. But I think in certain businesses, like lending, and especially, you have to be careful with that and making sure that you do comply. So one biggest learning is getting more patient about regulatory forces and complying with those things before going ahead and doing the product, because what I realized is that will actually impact the shape of the product, and sometimes it's not so easy to just reverse what you have built because all the requirements now will change. And because of that, we're better because I think we're more careful now as a company in terms of the products we've built. And as we grow, I think it's part of the nature. You can't just be launching code every single second and without having proper reviews and proper mechanisms in place. So as we become more of a bank, we realize that we have to, people have to trust us with their money. You can't just have a bug and your money disappears too. So we're being more careful about the speed in which we move, making sure that we prioritize quality over getting something out there, which is totally normal when you're a startup early stage. You just want to get stuff out there, get people to use it, test it, iterate. But now as we're starting to get users and scaling, we have to dial that down a bit.
Yeah, I think that's a really prudent advice, especially for those that are in fintech, to be mindful of that. Agility doesn't necessarily override the need for regulation. And then the localization aspect, because each domicile is going to have their own set of regulatory requirements, and that's becomes tricky as you think about globalization. So today I've been joined by Victor Santos, CEO of Airfox. Thank you for joining, Victor.
Thanks, Scott.